Justin Wine on Monday, November 18, 2013. We woke up this morning to the futures higher yet again. You might have said to yourself, well, here we go again. Depending if you were a bear, you might have said so in an exasperated, frustrated, kind of sarcastic manner. If you're a bull, you probably said so in an enthusiastic manner. And here we are after the closing bell, looking at this Dow Jones Industrial Average daily chart. And you can see we printed yet another all-time high today. A slight fade into the bell, but still the Dow finished in the green. Now, it's been an incredible run since October 9th off that 200-day moving average in the Dow. Remember, the Dow was a prior notable laggard compared to other major averages. Then all of a sudden it took the baton and became really a leader, especially over the past couple of weeks, and distinguished itself. But that goes to the issue, and this is something we've really been focusing on in these recaps over the past couple months, definitely over the past couple weeks, of focusing on the nature of the market. Not just saying, for example, hey, the Dow is V-shaping the new highs, therefore, because that's what the Dow is doing, all is well with this market. And, we're in this rip-roaring bull market where you could buy anything, and everything's going to break out higher. It just has not been that kind of a market. It has not been kind of the healthy, silky smooth uptrend, for example, we saw in the first couple of months of 2013. I would argue since the summer months, it's been much more of kind of a selective, rotating kind of market. You really have to stay on top of it on a day-to-day basis. That's what we try to do on these recaps inside our premium services, 12641, and the weekly strategy session. So while the Dow Jones Industrial Average, the mega caps here, found a slight fade, I would say, still closing the green above its upper daily chart Bollinger Band. We know after a very steep run over 1,000 points over the past month and a half, the NASDAQ Composite was a notable laggard. Again, that goes to the idea of really understanding that the market has seen these big spreads start to play out within sectors, between the major averages. The NASDAQ, again, has been a very impressive leader, 13-year highs, tried to tag that 4,000 level, big round number. It still might, but it did print kind of an outside day, or what's known as an engulfing day, a bearish engulfing day, after what's been a reasonably strong trend. So again, even though the NASDAQ doesn't look like it's sustained really any damage, you can see the NASDAQ Composite, to be objective here, closed above all rising and properly aligned daily chart moving averages, 20, 50, 100, 150 day, 200 day. But you want to push yourself to be even more rigorous than that. I mean, look at the components, some of the big marquee leaders, the four horsemen, if you will. We talked about these guys over and over again from the summer into the fall months. Facebook, very steep run. This was the beginning of it, the earnings gap higher. And now I'm still reticent to call this kind of the big head and shoulders top, but clearly we can agree that Facebook's momentum since mid-September, we'll call it, has clearly cooled off. I think, again, to be objective, you have to say that. It found some resistance at the 50-day moving average. It's tough to aggressively bet the house that we're breaking down. It's a high momentum, heavily shorted stock, still in an uptrend, still nowhere close to closing this gap. But that's not my point. My point in presenting this to you is not to say it's a high probability short. Rather, it's just to point you to that while the NASDAQ is still above all its moving averages, and even with today's reversal, really hasn't suffered any major damage yet, some of these individual names that have been marquee names throughout the summer and fall, they are a bit worse off technically than, let's say, the NASDAQ is. LinkedIn, another horseman from the summer. You could see it basically, we talked about this steep angle of ascent. It cooled off and it got weak, and it's kind of staying weak for now. Declining 50-day moving average. Netflix, no real damage yet, still above all these moving averages, but you could see a little bit of supply come in. Tough to short NASDAQ, the Netflix, I would say, not NASDAQ, but it's tough to short Netflix. No real damage yet. Still, you could see a little bit of a hesitation, let's say, at the 350 area. And then finally, Tesla, probably the worst of the four horsemen, or the most violent selling. Here again, does not make it an easy short by any stretch of the imagination. We've seen countless upside reversals in Tesla over the past couple months. Rather, my point is to draw you to the fact that momentum cuts both ways. Steep uptrend, the rubber band, and then it's kind of snapping off here. Look at these heavy sell volume bars. Just because something isn't an easy short or a high probability short per se, and again, if you're an aggressive trader, you could have been shorting Tesla. Some guys have. That's great. Good for them. But the point is rather to draw your attention to, is it a high probability long? I would say not exactly yet. The next level I'm looking at is probably 115. That's probably the next level to observe there. Turning to other leaders from throughout the year, marquee names, the IBB ETF for the biotechs. Again, another V-shaped rally and another kind of pause at these prior highs. Doesn't make an easy short, but this, especially after such a steep uptrend, I've been talking about this for a while. Look at the heavy selling bars going back over a month at least. It tends to, this kind of loose and sloppy pattern, it just tends to indicate a loud, violent disagreement taking place between bulls and bears. And when that occurs after such a steep uptrend, you just got to watch it a little bit, because it can mean bears might actually be gaining control. I know it doesn't seem like it when biotech just keeps V-shaping back higher. It could still go higher this time. It could be different. 213 looks like kind of a big level there for this biotech ETF. But again, this is a sloppy pattern. It's still sloppy even with this most recent V-shape higher. These are very strong ends of the market. Now, again, let's talk about some, on a more positive note, some potential rotation candidates. Emerging markets, you can see it's still a sloppy chart. EM ETF, obviously China was hot, I think for a while there. FXI, it did get slightly faded, but still a very good day. EM, I would be looking to confirm this strength, probably a move above 45 and a close above. Still a ways away. We'll see if that gets going. Keep an open mind as always. And of course, the financials, XLF. Look, it did reverse lower today, did the financials. My only concern, or my main concern, I should say, is that it's just a little too obvious that maybe a little bit too many people are kind of on the bandwagon, that financials are definitely going to benefit from rotation going forward. Recall our discussion on the Bollinger Band analysis. When they're pinched in or compressed like this, it indicates that a big move's coming, but sometimes, or oftentimes actually, especially when it's a bit too obvious, you get the first move higher and that's a head fake, or the first move lower, and then a reverses course and that's a true move. So my point is to keep an open mind, especially when you see momentum coming out of the market in many high profile names. You don't want to just assume rotation is at hand. Triple D, the 3D printing play, and we've been talking about this and this monthly chart is it looks like a dot-com kind of bubble look to it. Typically that ends very badly. We'll see if this time it's different, but here again you can see kind of a long-legged doji, or you can call it a spinning top candlestick today on heavy volume. I know it did finish in the green, but it's tough to go long Triple D. I think you could agree with me on that for anything more in day trade. ONVO, similar kind of thing here, very steep run higher. Tough to kind of, again, be long it here. Home Builders, XHB, look, they're still trying to sustain a rotation. I think Beezer, one of our members, AK Flyer, had an excellent trade in here, sold near the highs. That's a great job there. But my concern with the home builders remains some of the big prime time names with declining 200-day moving averages. They've been mired in corrective phases for months on end. Lennar, Pulte, PHM, those are two of my bigger concerns there. And DHI. DR Horton, you can see working through a descending triangle could be a bearish pattern when it occurs in a corrective pattern, in a corrective phase there, I should say. Russell 2000, of course, been a big leader this whole year. Today, once again, they diverged last week, did not make new highs as the S&P did, and now printing an outside day, just like with the NASDAQ. No real damage done yet, but it probably should slow you down a little bit until we see some confirmation that can move above 1120, 1125 with authority to the upside. I just don't want to get lulled into complacency. That's been my theme for a while. Insurers been very strong too, but again, my concern here is that you could see the KIE ETF for the insurers just now in a straight line pretty much over the past several months, getting back to its 2007 highs, from which it saw, obviously, like everything else, just massive rejections. So just watch out for overhead supply there with the insurers. Again, don't just assume these rotations are going to happen. I know it sounds sexy, but we saw how many fits and starts did we see with the semiconductors over the summer? That goes to the notion keeping that open mind. You can see the semis. Yeah, they've had some spurts here and there, but they haven't given us that kind of silky smooth rotation that we've been looking for. Now, Again, some names to watch. YNDX, for example, the emerging markets, I was pointing this out. I think Russian kind of internet play looked great, but then found some, resistance. So you got to watch that there. Yoku, again, looked great, but then found some resistance. So, again, guys, you just got to keep it open minded. This market, CTCT, nice play. I was looking for an entry here, but it's kind of basing, but it hasn't given us that trigger yet. 28.22, probably what you're going to look for there. So XOXO is the name Matanza, so 126 member and I were talking about all day inside our 126 service. Great buy volume today. Pretty good price action. Not too bad of a fade. Maybe that's an actionable idea to have on your radar into tomorrow. Ameritrade, some of these brokers, disappointing to see it reverse lower. See if 29.30, that would probably be our next trigger there. So I hope you find those ideas useful. Some of these credit card plays, Visa, if it actually cracks below 199, I think you might have a quick short trade if you're looking to be aggressive. Just be careful short selling names that are heavily shorted, again, like your Facebooks and that what have you, because they are prone to vicious short squeeze higher in a bull market. Just again, stay selective. That's pretty much the theme here. Last, again, gold miners closed just below 23.68. No trigger, no trade there. Again, we caught this nugget trade, the triple long ETF. The idea is to now be patient with it. Hey, look, if it cracks below again, I've been saying this for a while, if it really does follow through lower, maybe I'll look at DUS, maybe a 3x short ETF. Again, I'm trying to keep that open mind here. I'll take what the market gives me. Natural gas, we got a very nice quick trade here. UGAS triple long ETF, but now it's probably going to pause a little bit. Crude oil, still trying to find a bottom. Again, just it's gotten weak and it stayed weak. Key off the dollar here. Again, it circled back to its breakdown level, and now once again we'll probably get an indication for the next big move there. Treasuries, my sense with treasuries, even though they're an established bear market, is that treasuries, I think, are just going to frustrate everyone here into the holidays, and then maybe in January we'll look to get another leg lower. So again, I hope that helped today, guys. Google, I did take some profits earlier in the day on this one. Just did not like seeing the overall market theme. It's still an okay, it's still set up well, I should say. Again, I'm inclined to adopt that hit and run style in this kind of a tape as we look to be having kind of a mature bull market on our hands. And again, I do not want to get lulled into complacency. Overall, again, look, we're still above this on the S&P 500 index. The market's trying to accelerate higher, but when you see the construction of the market, your Facebooks and especially your Teslas and biotechs and those kinds of names, reverse lower yet again after another morning gap higher. Just my style is to err on again being kind of on the conservative side. Discretion is a better part of valor, that kind of thing. So again, let's see if the bulls can regroup, and if so, we'll keep that open mind and we have some setups to watch. If not, again, let's be prepared to keep those losses small, stay disciplined, and not get those big drawdowns.